Hello, and welcome to our Barebone Basics Session 2 Foundations of Investing. Today's agenda, we're going to talk about how to buy stocks, what drives a stock price, players of the game, and how to make money. I think that's something that everybody is waiting on to see. And of course, I'm going to leave you with something to think about. So our stock for the day that we're going to play around with a little bit, we're going to play around with Coca-Cola. Everybody knows who Coca-Cola is, and we're going to actually take a look at their stock, the stock price. We're going to find the ticker symbol for it and look at some of the information that's provided about the company that can help us to make a decision whether to buy or find out what kind of dividends, if they have any goodies for us, what date dividends may come, and we're going to actually talk about what a dividend is tonight. So the first thing you have to do when you want to buy a stock is you have to create what's called an order. In the golden days, you would actually pick up a phone, call your broker, which we talked about what a broker was last week. That's your dealer, your stock dealer, the person who stands in between the buyer and the seller and makes the deal work. In this case, we use either an app on our phones to buy stocks, or you can use your online broker. So things happen pretty fast now. We don't have to pick up a phone and wait anymore. But when you place an order, there are certain things that are going to be consistent across the board, no matter which broker you decide to use. The first thing is you're going to have to know what the ticker symbol is. I'm going to show you in a demo how to find a ticker symbol a little later on. You're going to have to tell in the order the quantity of shares you want to buy. Remember, we said a share is a piece of a company. So how many pieces of a company do you want to buy? You have to tell which side you're on. So do you want to buy or do you want to sell? Are you the buyer or are you the seller? Now, most deals, if you're buying based on the type of order you're making, which we're going to talk about in a second, you may have to give a price. So there are two types that we're going to talk about today that are kind of basic. There are more than this out there. So if you actually go to buy a stock and you see 3 or 4 or 5, 6 options for the type of order, the two main types we're going to work with are going to be market orders or limit orders. A market order, you're basically saying that I will want to buy a stock or several shares of a particular stock, but I want it now. It doesn't matter if the cost shifts up a little bit or down a little bit. I just want to get the stock as soon as possible. The reason why we call it a market order is because you use this when the market is open. You can only purchase stocks, shares of stocks, during the business hours of the stock market. So how is this good and how is this bad? The good thing is if there's something I want to buy and I want to buy it quickly, I can, as long as the stock market is open. The bad thing is, let's say I decide Friday evening at 8 p.m. that there's a stock I want to buy. I just ran into an old friend and they're telling me about this stock that they're investing in that they really, really like, and I look up the information about it and I like it too. So I go ahead and place a market order at 8 p.m. Well, guess what? The stock market is closed at 8 p.m. on a Friday. That order is not going to get filled or completed, as we call it, until Monday morning at 9:30 a.m. A lot of things can happen between Friday and Monday that can cause the price of a stock to shift. It could go up in cost or it could go down. A lot of things can happen. And we're going to talk about things that cause the price of a stock to shift in just a second here. But with a market order, that's the danger that you run. Now, if you're just buying 1 or 2 shares or 5 shares, it doesn't make a major difference. But imagine if you wanted to buy Coca-Cola, and let's say their stock price was $50 on Friday when you place the order at 8 p.m. If the price shifts for some reason, goes up to $51 or even $50.50 by the time your order is placed, and let's say you ordered 100 shares, 100 pieces of Coca-Cola. Well, 100 times 50-cent difference, that adds up. So when you're making a large quantity order, that's where placing a market order can be a little tricky. But if you're just doing small amounts at a time, do a market order. It will not harm you as far as the price change that much, because the price will not shift in a major way. So you're not going to have Coca-Cola $50 on Friday and $100 on Monday. That's unheard of. But for it to shift 10, 20, 25 cents, okay, that can happen, because the market can open with there being a lot of things happening that may cause a stock to shift in price drastically. Drastically meaning 10 to 25 cents, not in dollars. So if you're buying in small quantities, market is great. If you're buying a large quantity of stocks, that's where we want to start looking a little different. Like I said, if you're buying 100 shares, if you're buying outside of the hours of the stock market being open, then that's when you want to keep that in consideration. If you're purchasing your stock with like let's say you're using Robinhood or Cash App to buy your stocks, the only choice you have is a market order. And if you place an order outside of the market hours, stock market hours, you'll get a message saying that they'll fill the order as soon as the market opens back up. That's letting you know that it is a market order, so you're fine there. And plus, they have limits on the amount of shares you can purchase at one given time. So doing market orders won't hurt you that much if you're purchasing, like I said, in small quantities. So let's take a look at a limit order. What a limit order is, it's setting a limit to the price. So using Coca-Cola, once again, let's say it's $50 a share. I might have some insight that says that the price may go down soon. So I don't want to buy at $50. I want to buy at $49.50. If I do a limit order and I set the price to $49.50, the order will not be filled until it meets what my limit price is at a minimum. So if it goes down to $49.45, it still meets the limit. The limit is no more than $49.50. How does this play out? Well, let's say you're ordering a large quantity of stocks. In case that the price starts shifting on you, let's say you're buying on a Friday night. It was $50 Friday night. I want to buy at $50. If it changes when the market opens and it shifts higher, the order won't be placed because it doesn't meet my requirements. There are different types of limits that you can do. You can set it to where your limit order stays open for 30 days. If it never hits in 30 days, the number you want to buy at, it cancels the order. You can have the order stay open until you actually cancel it. Now, the reason why I'm not recommending limit orders if you're just getting started is that it's very easy, and I'm telling on myself because this happened to me. I'm giving you the good, bad, and the ugly. I had left some limit orders open, and they just sat there, and I forgot about them. And guess what happened? My bank account got hit with a few orders that I just didn't know. I forgot that they were there, but it hit the price I wanted. So it wasn't a horrible thing. It was just unexpected. So that's why I don't recommend limit orders until you are comfortable. And if you're actually paying attention on a regular basis to what type of orders you got out there and what's going on. If this is your daily habit, then limit orders are okay for you. I prefer to use limit orders if I'm ordering a large quantity of a stock, simply because I don't want to be affected by the spread of the cost changing. So like I mentioned, 50 cents is a lot when you're ordering hundreds of shares if it were to change that drastically. But even at 10 cents, if you're buying 1,000 shares of something, 10 cents can add up quickly. That's going to take away from my profit of the stock when I sell it. So market orders are when you're just getting started. I highly recommend using market orders. Just make sure you place your orders during the hours of when the stock market is open, which is from 9:30 in the morning to about 4 p.m. Eastern. For me, I tend to buy stocks between 10 and 2. Those are my hours to actually purchase. Unless there's something really, really great happening that, like I said, if I find out about it and I want to go ahead and put an order in for it and I'm not buying a large quantity, then I'll go ahead and place a market order outside of hours. So all that being said, let's take a quick demo. Let's take a look at Coca-Cola. We're going to do a review of Coca-Cola. I'm going to show you how to find its ticker symbol. And I'm going to show you how to place an order without placing an order. So let's go take a look. All right. So we have a few websites here that we're going to work with, starting with Yahoo Finance. This is one that a lot of people still use to actually do some research as far as finance is concerned. So our company that we're playing with is Coca-Cola, and I chose this one for a reason. Coca-Cola has several entities, it's multiple businesses in one. So if I were to actually go to search, if you're in Yahoo Finance, go to search, start typing in Coca-Cola, and you'll start seeing some things come up. I stopped with just the COC so that you can see that here. The symbols are on the left, the name of the company here. So if I click on the name of the company, the symbol KO, the Coca-Cola Company, I can see its current price at the close of 4 p.m. Eastern time, which is the time that the market closed. I could actually buy and sell, but I don't have an account with Yahoo, so I'm not selling from there. Things that are important, I like to know the opening price. So when the market opened, what was the value of that stock? $53.94. At the close of the day, what was it? $53.95. So it only shifted by 1 cent by the end of the day. I like to look at the 52-week range. So what that's saying is in 52 weeks, which is 1 year, what was its lowest cost or value, which was $44.42, and what was its highest value, which was $53.95. Well, why do I want to know that? Well, I never want to be at its lowest end. That's for sure. If it's below, if it looks like it's trending to its lowest point, that can give you some indicators. But for starting out, you won't have to look at this much because the type of investing you're doing may be different. If you are purchasing for the purpose of dividends, then, which is what I mostly do, then this actually comes into play when I'm just taking a glance at my stocks, because they're going to shift daily. They're going to go up and down like a roller coaster all throughout the year. And to keep from going crazy, the numbers I look at is the 52-week range. What is its high and what is its low? If I see it constantly going down and it's getting closer and closer to its low, that may be an alert for me to take a deeper look, to do a little research, see what's going on with that stock. That might make me move. But just to see it was $53.95 today. Tomorrow it might be $52. Because I know it goes on a roller coaster, that's not enough to move me. But if I see that it's constantly going down and it's getting closer to that 52-week low, that could be a cause to go take a look and try to find out why. There may be some things going on in the market that's causing that change that is that's temporary. There could be some things that we're saying, hey, Coca-Cola, what are you guys doing? Or did you get sued? Did someone find something in one of their drinks or something and you got sued? Or is it just people are shifting from drinking sodas and they're drinking healthy drinks now? Your earnings have dropped. It gives me an idea to go look. So that's my alert. Other things that I pay attention to, very important for those who are going to be purchasing for the purpose of dividends, is what is the dividend date? Ex-dividend date is the date that the company, in this case Coca-Cola, will take a look. It will pull a let's say a screenshot. It'll take a snapshot of the total number of shares, pieces of the company, that each stockholder, you, the person or shareholder, you, the person who owns that share, the stock, how many do you have on this date? So if I owned 100 shares on November 29th, that was the last ex-dividend date. They pay out quarterly, so the next dividend date will be probably, they'll post it by January, mid-January. So on that date, if I have 100 shares, then that's the number they're going to take and multiply by the amount of money they're giving in a form of a dividend or interest. So that date is important because there's a little game that I play with my dividend stocks where I will shift and move some things so I can have more of another. But we're going to play that game on another day. Today, it's about learning how to buy a stock and what to look at when you see all this jargon on the screen. And for some people, it's intimidating. So what I'm saying to you today is a lot of this you don't have to pay attention to, at least not right now. And it all depends on the type of investing you're doing. For example, you see the analyst recommendation says hold. Well, sometimes I pay attention to what the analysts are saying and sometimes I do not. Well, how do I decide that? I decide it based on my purpose of buying the stock. If I'm buying a stock for the purpose of dividends, then my theory shifts a little bit different from what the analyst theory was. The analyst is looking at it from the standpoint of how much the stock is going to grow or if it's going to go down as far as its value. This $53.95 is what they're paying attention to. Now, do I absolutely never take into consideration what they're saying? No, that's not the case. I will, when I'm doing my research, I do take a look at what they're saying, but more importantly, I look at why they're saying it. If they're saying that a particular market is about to crash and burn completely, a particular sector, let's say they said that they are suspecting that no one's going to buy sodas anymore in 2 years. That's huge if you're with the Coca-Cola company. But if I also know that Coca-Cola is coming out with different forms of healthy drinks, that can off shift that. So those are the type of conversations I get into or think about when I'm looking at what an analyst is saying about a stock. But we're going to get deeper in depth with research and how to process what they're saying on another session. So for now, you can take a glance, but don't let that either steer you one way or the other, depending on what your purpose of buying that stock is for. If you're buying a stock for the purpose of dividends, like I said, you need to know this, the ex-dividend date. I also like to know what the actual dividends is going to be. Now, mind you, it's a little bit easier to see it on another platform. I don't particularly care for Yahoo Finance, but I do know a lot of people use them. Let's take a look at CNBC. So for the same stock, if you go to www.cnbc.com/stocks and go to that right-hand corner where it says search quotes, once again, I'm going to type in COC. And I'll instantly see here is Coca-Cola Company, KO. If you click on it, this will show you their information that they'll provide on the stock. Once again, you see the closing price was $53.95. The plus 18 or plus 0.33% is the gain. If it went down, it'll be red and it'll be in negative. It will be in a negative. The 52-week range, which I mentioned, that's something that I do like to see. I will take a look at charts sometimes, but it all depends on, once again, what is my focus, what is my goal. The key stats, the ratios, once again, if I'm buying a stock for the purpose of dividends, I want to know the dividend yield, which in this case is 2.97%. A dividend yield it's the percentage of how much you will get in the form of interest over the course of a year versus the cost of the stock. So if I'm getting $2 a year per share and the stock costs me $53.95, then the dividend yield is 2.97%. Now, this is relatively low, but there's a reason why some people prefer something like a Coca-Cola company, and that's because of their stability. And we're going to talk about some companies that you can find like this and what we call the Dow. And we'll talk about that a little bit later on in this session. The actual dividend that they're given is $1.60 per share. This is probably annual and not quarterly. So they will, if you divide this by 4, then that's what each share of stock would receive based on how many shares you have on that ex-dividend date. I prefer to use my E-Trade because it just looks a little bit cleaner and it has more details that I like. Now, I already have this set up on one of my dummy accounts that I play around with. It has a little bit of money in it, but it's not my main account here. I like to play around with stocks before I actually put a lot of money into them just to see how they would go. I have Coca-Cola Consolidated. If you notice, this isn't the same price. That's $273.86. Remember I said there are several Coca-Cola companies. This is Consolidated Inc. We want, if you type in the ticker symbol that we found, if you don't know the ticker symbol, usually you can just start typing in the name and it will come up. In this case, we do, so I'm just going to type KO and go to KO for Coca-Cola. Once again, here's the last price, which is important. Today's gain and changes. What I like here is, yes, it shows me the dividend yield, but it shows me exactly how much each quarter it's giving out right now. Now, will this be the same every quarter? No, it can shift up or it can shift down. When we start working on how to research a stock, one of the things that we're going to look for in dividend stocks that we buy is what is their dividend growth over the last 5 years. If your dividend growth is constantly going down, meaning if this was Coca-Cola, this quarter is 40 cents, next quarter is 36 cents, next quarter is 32, that's not good. I want a company that's either consistent or consistently giving the same thing or at least growing, one or the other. And usually I want that in the course of at least 5 years. If you've been giving out dividends for 5 years, then you're probably somewhat stable as far as a company is concerned. I want to know the ex-dividend date, which the other tools we use, which was Yahoo Finance and CNBC, but what they didn't give us, I want to know what day I'm going to get paid. That's the dividend payable date. So the ex-dividend date is the date that they check to see how many shares you have. The dividend payable date is the date that they're going to send me a check for the amount that they said I could have. So 40 cents times however many shares. So if I have 100 shares, 100 times 40 cents, I'm going to get a check for what, $40? Or I can have it reinvest, which is called a DRIP, DRIP, which is a dividend reinvestment. I do dividend reinvestment because I am trying to build up my number of shares. So it's going to take that $40 and it's going to buy $40 worth of Coca-Cola. Given that the price is $53.95, I'm not going to get the whole share. I'm going to get a part of the share that is equivalent to $40. That adds up over time. And it helps you to compound and keep building. Now, like I mentioned before, I prefer companies that are between the $10 to $20 range. That way I can buy a lot more shares. I also like the dividend yield to be closer to 7% for me so that I can earn more faster. Quarterly dividend, this is not as important as how much you pay for a stock and how much they are versus how much you're getting. And that's where dividend yield comes in. If you're getting a 6 or 7% yield, that means that based on the amount you spent for the stock, you're getting a decent dividend back for it. And also, I know exactly when it's going to happen as far as quarterly. That knows that I know I'm going to get either a check or a dividend reimbursement or a reinvestment, 4 times a year because it's quarterly. There are some out there that are monthly as well, and they will state that they're monthly. So those are things that I look for there. Now, one more quick perk that I'm going to show you before we actually try to buy a stock here is insider activity. We're going to talk about insiders in a moment as far as types of players that are at the table. The reason why I look at insider activity, insiders are your officers of a company, your CEOs, your COOs, your CIOs. They typically have a large amount of shares. So if I scroll down, you'll see, for example, Quan Nancy is an officer. What was the transaction? Quan sold shares. How many? Quan sold 24,000. How many does Quan hold? Quan still holds 168,692 shares. So in that case, that's not huge. But if Quan sold all his or her shares and you're an officer of the company, that's a red alert for me. If all of the officers are selling, so am I, because they know something that I don't know. And I'm not going to sit around and wait to guess what's happening. They're not allowed to share the information as to things that will shift the price of a stock. That's called insider trading. But they can sell their stuff. And this is as close as I can get to knowing what's going on in the boardroom based on how they sell or buy their shares. So I see Chang bought shares. She only bought for Lisa Chang there. Their names are opposite here. Last name, first name. Bought 500 shares. Okay. No one's really selling off everything in massive amounts. So that's not there's no alert here. If I saw sell all the way down the line, red alert for me. If I see buy all the way to down the line, that's an alert for me, but it's a good alert. Okay, you're buying up a whole bunch of shares. Why? Well, what are some of the reasons why someone would buy up as many shares as they can get? Well, if I know that my company is about to do something grand that's going to make them a lot of money, I want to get shares at the lowest cost I can get them at. So if I can buy shares at a lower cost than what I expect them to be in the next 6 months, 3 months, because something huge is about to happen to increase the value, then I'm going to buy up as many as I can so that I can sell them at a later date at a higher price so I get more profit from them. So once again, if I see sell, that's red alert. Hey, something's going on over there at Coke. If I see buy, where they're buying or purchase in large quantities, large meaning 100,000 at a time, 50,000 at a time, that's a red alert for me if there's a lot of people doing it, or just a few. If I see 2 or 3 people buying up large quantities, I want to know why. If I see 3 different people selling in large quantities around the same time period, I want to know why. So that's an easy alert. So I do pay attention. This is called insider activity. Pretty much any tool you use is going to give this information. It's just a matter of finding where it is. E-Trade makes it simple. That's why I like them. So that is our demo of that. Let's go through buying a share of Coca-Cola. So we have my dummy account up. First thing you got to have is a ticker symbol. As I mentioned, we have KO. What action do you want to do? Do you want to buy or do you want to sell? We're not going to do a buy cover. That's beyond basic. So we're going to buy. How many do you want to buy? Let's say we want to buy 1 share. The price type. Remember I said you can do market, limit, and there's several others. Our focus is limit or market. If we were going to do a limit, we would have to put a price. So if I put the limit at $53.75, what's the duration of this limit? Is it good for just one day? Is it good for 60 days? Is it good until a specific date you set, or until it fills or you kill it? So you have options there, but you do have to set a price if you do a limit. Let's say we're going to do it at market. Market, your only option is good for the day. That doesn't mean that it's only going to sell it on the day that you put it. It's good for the day whenever the market is open at its best time, and whatever price that it is at that moment. And then you would click on preview. It would show me that, hey, this is what your order is. You hit submit and you've now I would have bought a stock. It's that simple. No matter what tool you're using, this is pretty much what you're going to see. They're going to want to know what symbol. They want to know, are you going to buy or are you trying to sell? If you're trying to sell, how many are you trying to sell? I have 1 share of Coca-Cola sitting in here for the purpose of, if I wanted to sell it, which I don't, I want to leave this in here. I could do the same thing. Am I selling at a limit? Am I selling at market? So if I'm selling at a limit, I'm saying don't sell this share until it reaches, let's say it's $53.94, unless it reaches $54.50. Until it reaches that, don't sell it. And it will sit out there for as long as you tell it for the duration. And once it reaches your limit, then it will sell that stock. And it's that simple. So like I said, no matter what tool you're using, this is the basics of what you're going to be doing. The main thing is find a tool that you're comfortable with. There's several out there. As I mentioned, I particularly like E-Trade. I've been with them for years now. I have 2 accounts. I have my dummy account, which is this one, and then I have my real account that I buy from. So that's what we have as far as for our demo today. Let's get back to our training. All right, so we've gone through our demo of Coca-Cola. We found a ticker symbol. We found out how to find a ticker symbol. And to be honest, if you just type the name of a company in Google, it will come up with the ticker symbol. It's pretty simple to find a ticker symbol. So those are some ways you can actually locate one. And also we went through how to place an order. So let's keep going here. So what drives a stock price? The technical answer, supply and demand. You have sellers, you have buyers, you have a certain supply. So if we have a large amount of stocks that are available, or number of shares that a company has issued that are available to buy, and the demand is great for this stock, the higher the stock price is going to be a little higher. The higher the demand, the more the stock is going to cost. Now, starting out, the actual, we'll say Wall Street decides what the value of a company is. There are things that go into that called the valuation of a company as far as its overall complete value. So if a company is worth $50 million and the total number of shares of stocks that you have outstanding, the number of shares of stock outstanding is basically the total number of shares of stock a company has. If you divide those, that's going to give you the actual general idea of how much this is going to cost here. So when the demand is created by people wanting to buy those shares from investors who already own them, so the price will shift up or down based on the number of shares available to sell versus the price buyers are willing to pay or the price sellers are willing to sell at. That's the technical answer. Our bare bone basics answer is the herd determines the price. And what I mean by the herd is people, us, how we think, how we feel. People, politics, emotions. For example, you've ever heard of the saying that when one person starts running, we all start running? That applies with stocks. If a certain policy comes into place, as far as politics is concerned. Let's take something real world that's happening right now. Let's take China. Let's take cars. Let's take tariffs. If the idea of tariffs coming soon to a certain country, and there's products that we get from that country, the cost of that product is going to shoot up because it takes away from the company's ability to make money. With that being said, we will assume that the cost of that stock is going to drop. So there's some assumptions there. So if you are a owner of shares of that stock, guess what you might start doing? You might start selling and getting out before you believe it's going to hit rock bottom. If there are several people doing this at the same time, the herd is going to follow. And of course, the price of that stock is going to drop because there aren't as many buyers wanting to buy it anymore. So that causes a shift. Let's say Facebook. When we found out Facebook was, in lack of better terms, not protecting data as well as they should have, guess what happened to their stock? The stock dropped, and it was dropping fast. Why? Because the herd started selling off shares of stock, and they were selling it fast. That's why I'm always saying to take your emotions out of it, because if you can play the game, we're playing chess, not checkers. If you can play the game in understanding how people think, you can guess which direction they're going to go. If you can guess which direction they're going to go, don't follow the herd as long as it makes sense. Now, if there's a fire, you need to be running too. Now, we're going to put some common sense to it. But a lot of times, the herd runs based off of their emotions. They run based off of things that is put out in social media. Things that are said in the news, or the whichever direction media decides to take something. Or if the current president decides to say, hey, I'm going to throw up tariffs next in the morning on his Twitter account, it makes the market uneasy, and it makes people make decisions swiftly and quickly. And a lot of times it is a temporary shift, not a guaranteed shift. And what I mean by that is, let's say, okay, perfect example. I'll use one of my own examples. I have BP, which is an oil company. And there was a spill. This was several years ago. There was a spill, and the stock price went down. I mean, it plummeted. I went out and bought every possible share I could afford to get. Reason why? They give great dividends. This was something that was temporary. They could bounce back from it. Give them good 6 months, and that's exactly what happened. So I bought shares of a stock for at least $10 less than what it would normally sell for. I got it at what we call a value, because I went the opposite direction of the herd. The herd started selling off like crazy. And I just took a chance. Now, I'm a little bit riskier than some. I'm not too risky. I'm not crazy. But I'm a little riskier than some. But in that case, it was a perfect example. The company is a solid company. They didn't have tons and tons and tons of debt. So I looked at their financials. And like I said, we're going to go over how to research a company and kind of get an idea of their strength. It's a strong company. Like I said, they've consistently given great dividends. They were a good dividend holder if you hold their stocks. And something just happened that was a temporary thing. But the herd took off. The herd went one way and started selling. I went the other way and I started buying, and it paid off for me in two ways. One, if I wanted to sell those stocks right now, the ones that I still have of BP, I would make a profit by its growth because I bought it at a discount value, and it went back up as far as beyond the point that they were at as far as their value, their cost. Two, I got more dividend stocks so that I could earn more quarterly at a cheaper rate. So that's what I mean by the herd. The herd determines the price. Wherever the herd is running, that you need to find out, is it temporary or is there a real fire? If there's a real fire, you need to go run too. If it's not, if it's something that is temporary, it's not going to kill the company. With BP, the oil spill was bad, but not bad enough to take them out of business. That's the part where your thinking comes into play. That's the part where your research comes into play. That's the part where you take your emotions out of it and you look at the facts. So as far as the herd, who's the herd? The herd is people, politics, social media. A lot of things that drive the herd is emotional thinking. If you can get out of the emotions, take your emotions out of it, and look at the facts about a company, you can do really well when it comes to stocks. But because the herd runs a lot all the time, and you can catch those temporary shifts and do really well. So there's two terms that you've probably heard about before called bullish and bearish. And this is what the herd does. Bullish means that the herd, and I misspelled the word herd there. Oh well. The herd believes a stock price is rising. So that means they're bullish. The herd, the majority of the people who are buying stocks believe that this stock price is going to continue to grow. So they're buying as much as they possibly can. What do you do? Depends on their reason, because it could be right. They could be right. This stock could be really well and growing. Facebook was a good example of that. They were bullish, and it wasn't a temporary thing. They were growing at a fast pace. And of course, I bought in on them early when they were $17 and $30, and now they're almost $200. Bearish, the herd believes the stock price is going to fall, so they start sell. That's the moment in time where I'm looking to buy. If it is a temporary shift, because at that time, the stock price is going to fall because the herd is all selling their shares of stocks because they believe it's about to fall. But before I jump in, I want to make sure that there isn't a fire and that this is more than likely a temporary shift. If it's a temporary shift, then I believe that that company can recover from what's going on. So what drives a stock price? The herd. Either they're bullish or they're bearish. But it's the herd, it's their emotions, it's our emotions, it's politics, it's things that are going on. For example, Johnson & Johnson, their ticker symbol is JJJ. When they were sued some time back. It was a huge lawsuit too. It was millions that they had to pay out. Of course, that affect the value of their stock, but it wasn't enough to cancel them out, whether they were just going to plummet as a business. So if a company is getting sued and it's multi-millions of dollars, but it's a strong company, that's something they can more than likely bounce back from, but it is going to cause their stock price to drop a little bit. So that's something that may be a temporary shift. So that's one of the things I look for. I look for temporary shifts if I'm looking to buy at a value. Now, if you're buying dividend stocks, you're not always looking to buy at a value. You're just looking to get some stocks so that you can get interest on them. But if you can buy them at a value and get dividends, that's a great place to be. So let's take a look. Who are the players of the game? Now, we've just said it's the herd. But what is the herd made of? We have what we call institutions that do institutional sales on good news. So when we talk about institutions, we're talking about trading firms, mutual fund portfolio managers, hedge funds. And what happens is, if you think about what a mutual fund is, where it's massive amounts of stocks, shares of stocks, different kinds of stocks. And if they need money, let's say someone wants to sell off some of their mutual fund or they're closing their mutual fund. That means they have to sell some shares of stock to be able to come up to produce the money to be able to give to people. They will have some funds on hand, but if it's massive, a large amount of money, they're going to have to sell some shares of stocks. That doesn't mean they're going to go sell the ones that you have in your mutual fund. They may find something that has done really well over time. Let's take Facebook, for example. We'll just use them. Facebook has done really well. They've kind of plateaued and evened out a little bit here to where they're consistently in that $200 range. They may sell some Facebook to be able to bring in funds for the purpose of distribution, or they may sell some of their shares of Facebook so that they can go and buy something that is of value at that given time. So let's say if BP was the company of value because the cost of the stock dropped and it was a perfect time to buy a bunch of it, lots of it at a low cost. So they will shift around what they have in the portfolio based off of what's happening in the news. They will do it based off of, okay, I have something that's really good that I'm about to get some good news on. We know some good news is coming about this stock. People are going to want to buy this. Let's go ahead and sell some of it now, and then we'll take that money and go buy something else that we can buy at a value. Well, if you know that's how the game's played, the same way I showed you the insider trading, you can find that same information on institutional sales. It's free information that's open to the public. So if I know that can kind of give me an idea of what's going to happen in the market on the day. If I know institutional sales are going on, now when institutions sell shares of stocks, we're talking lots of shares. We're not talking about 5, 10, 15, 20, 100. We're talking tens of thousands at a time. That will definitely affect the price of a share if it's a large, massive amount. If they're selling, then maybe that might shift it down a little bit. It might be a good time for me to buy value. Or it could be they're selling for a reason. And if I can find out that reason, the same way with insiders, I might also sell as well, all depending. But it's just good to know. Do you have to keep up with institutional sales? Not particularly. I have a different method I use them for. If I have a stock that I want to buy, I may look and see who are the holders of that stock. If institutions feel it's good enough to keep in their portfolio, maybe it's good enough to keep in mine. If I see across the board that several are selling, several institutions are selling, that's a red alert for me. Why are y'all selling all of this stock? Does that mean I have to panic? No. Does that mean I get in my emotions? No. It could be for a very good reason. It could be just that they're shifting their portfolios around to be able to find something to purchase of value at that current time. But that's good information to know. You have investors who are typically long holders of stocks. That's our buy and hold type of people. And then there's single individuals like you and me who buy and sell on our emotions. These are the people that make up the herd. They're the players of the game. BBB, bare bone basic, what do? We check institutional holdings of a stock. If they're buying and selling, that means they know something that you don't, possibly. And we want to definitely be in the know. Now, how often do I check this? I don't check this on a regular basis because I buy for dividend purposes. The only stocks that I actually check institutional sell on, maybe if I'm getting ready to buy something that I'm not familiar with. I'm not familiar with the company, or I'm not familiar with that particular sector. For example, I'm not too familiar with pharmaceuticals. I don't get it. I have a slim understanding, but as far as me trying to pick a stock to buy, I don't know enough information to know how to go about understanding how it works. But I can find someone who does, call institutional sales. That might be one of the reasons I might use that information in picking a stock. All right. So how do we make money? I think that's the most important thing that people want to know. There are different ways you can make money with stocks. You can hold for a long period of time. It's called go long, where you buy a stock and you hold it. And you buy it at its cost with the idea or perspective that if on the long run it's going to grow. It might grow slowly, but you're expecting in 2, 3, 4, 5 years that it's going to grow pretty big. Long hold, you're going to buy these stocks to hold at a minimum of a year. Now, you can sell them at any time if you want to. The reason why you buy and hold is more so for tax purposes, because when you buy a stock, as far as taxes are concerned, if you hold a stock for at least a year, then instead of paying income taxes on it, which you can be in 25% up to 35% range, you pay what's called capital gains tax, which is only 10%. I'd much rather pay 10% than 35% on any given day of the week. So buy and hold is one concept, but you're buying and holding on the terms that you believe is going to grow. Value stocks, you buy a stock at a low value and you sell it at a high value. Perfect example was my BP example. When the stock dropped because of an oil spill, it was a value stock because the company was worth more than what the current stock price was saying. The price went down because of the oil spill. They were going to come back from that. So buying it at a value and then selling it later. So let's say the normal stock price is $75, and because of the oil spill, it might have dropped down to $60 in the end. If I buy at $60 and it comes back up to $75, and let's just say it stops at $75, let's say it comes back up to $70. For every share that I own, I would make at least a $10 profit for each share. If I owned 100 shares, that would have been a $1,000 profit by buying at value. If you bought 10,000 shares, then that's what 10,000 times $10 is what you would have made. So buying short is risky. I do not recommend it for anyone who is new to playing around with stocks. And the reason why is because you're betting on the loss. You're betting that the stock is going to go down in price, but you're borrowing stock from someone else and then betting on it. We're not going to get too much deeper into that one. Just know that it's risky. The risk is that there's an infinity of how much you can lose. Whereas if you buy long, the most you could lose is how much you paid. With buying short, it doesn't stop there. It could keep going and you could owe a whole lot of money. So I don't recommend that unless you've been to training and have a good understanding of what that means. Then there's day trading. Charting is required here, but basically you're buying and selling based on movements of a stock within a day. Usually you're going to have something called a marginal account, and basically you'll have to get approved for a marginal account. What a marginal account is let's say you are investing with $10,000. They're going to give, instead of your $10,000 may represent $100,000. And that way you can buy more, but that $100,000 is not all yours. It's kind of like a loan. Think of it that way. But charting is required and it becomes a job. I'm not a fan of day trading because I have other things to do. I can't just sit in front of a monitor all day looking for a price to go up and down. So I'm not a fan of it. Some people have done really well with it. It's just that I don't have time, and that's why I can't do day trading. My friend, my favorite, which you guys should know by now, is dividends. That's interest earned from a company's profits. Two things, as I mentioned before, you need to know is the ex-dividend date and the payout date. I like to buy into companies that are between $10 to $20 per share so that I can buy lots of them. I don't buy into a name. I buy into what is your dividend yield and how strong is your company. Because even though I'm getting dividends, I don't want my stock to drop so low that if I were to try to sell it, all the money I made I've lost because it was $15 when I bought it, now it's $1. Now, how rare does that happen? Very rare. You should be able to catch those type of drops well in advance, because if they're dropping that badly, they're not going to give you dividends. A company can only give dividends if they're making money, because that's what you're getting, the interest earned off of a company's profits. So let's say Coca-Cola, our sample company for the evening. Let's say Coca-Cola for last quarter, their net profit was $30 million. The board of the company may say, well, we're going to give our shareholders a certain percentage of the total profits we made. That percentage, let's say they're going to give away $10 million of their profit to their shareholders. The total number of shares that are given out or that are currently out on the market that sellers own and buyers own, if you divide that total number by the total amount that the company is going to give away to its shareholders, that then becomes the actual amount that you will receive per share. So in this case, that amount was 40 cents. Now, do you have to know how to calculate that? No. Only thing you need to be able to do is go to your tool, your broker, and look up the company, and you'll see what the dividend amount is. If it says yearly or annual and they're paying it out quarterly, you're going to divide that number by 4. If it says quarterly, then that's what you're going to get. In the case of Coca-Cola, it was 40 cents per share. So if I own 1,000 shares of Coca-Cola, multiply 1,000 times 40 cents, that's the check I'm going to get on the payout date that they've named. So if you actually play your cards right and find companies that are between $10 to $20 a share and space them out to where you have companies that are paying out dividends, the way it's set up, you have some that pay out in January, some that pay out in February, some that pay out in March, on down the line, you can have a nice check coming to you every month. I don't know anyone that doesn't want $1,000 check coming to them every month for work they didn't do. That's how you kind of look to set up your dividends. And there are definitely several tools out there to help you find stocks, as far as finding ones that give a good yield, finding out when the ex-dividend date is and when they pay out, so you can set up your portfolio in a way that works. And I'll probably post soon I'll give you guys a website that is pretty good at providing some companies that are good to have so that you can space it out over time. And it takes time to build this up. But if you start now, by the time you finish letting it roll over and you do this consistently, my goal was every month when I first started out, every month I would set aside a certain amount of money out of my paycheck to go towards buying my dividend stock so that I could build it up, because it doesn't happen immediately unless you have tons of money. But if you start, even if it's just $1 and $2 that you're getting, build it up, because that $1 and $2 can turn into 10. 10 can turn into 100, and 100 can turn into thousands. So that's how you make money with stocks. Basic methods of making money with stocks. Of course, there's others, but these are just the basic ways. So what is our something to think about? We have what we call indices. And an index is an index of various organizations or various companies that are on the stock market. You've heard of the Dow, S&P, NASDAQ. So what the Dow is, the Dow has the top 30 companies who are on the public market. So these are established companies that have been around for a long time. These are companies that 9 times out of 10 are giving dividends. They might be low dividends, but they're giving dividends. The reason why they're on the Dow 30 is because they have been consistently doing well over time. S&P 500 is the top 500. And then we have NASDAQ. So if these are the top companies in the stock market, how can you identify stocks to purchase? Warren Buffett stocks are in the Dow 30. When I first started out buying stocks, I bought only from Dow 30 because I felt comfortable. Now, I didn't buy all 30, but the stocks that I picked and choose were from the Dow 30. If you were to take a look, and you can just Google Dow 30 and you'll get a list of all the current companies that are on it, you'll notice very commonly known companies like Nike, like Johnson & Johnson, Home Depot, companies like that, companies that have been around a long time, that are still financially doing well. What you won't see is new companies like your Facebook, like, Uber's on its way. You won't see any new companies on the Dow 30. You're going to find companies that have been around for a long time on the Dow 30. So if you want to find a stock that you feel kind of safe with, safe meaning not so much that it's going to grow a lot, but safe meaning that it's not going to plummet on you anytime soon. Even if it does go down, they're strong enough that they can bounce back up. The Dow 30 is a pretty safe place to start. So just something to think about. Warren Buffett stocks are in the Dow 30. All right, so that's our session today. Went a little bit longer today. We had a lot to cover, but I wanted to give you guys a demo to try to put some real world into it. So as usual, if you have any questions, please feel free to send me an email or chat with me in our Facebook private group. Have a great evening.